So, good afternoon, everyone. Welcome to our today's session. This is our fourth session, and that is our fourth topic out of 8. So today, I want us to discuss about the accounting for pension. Now, just to give us a brief overview about the pension, and I'm very sure this is not the first time most of us, if not all of us, we are hearing the word pension. So pension basically, or in a layman language, as we are all aware, is the payment that we receive when we retire from active service, reaching a certain mandatory age for you to receive the pensions. And now pensions basically they are given by employers both in private and in public sector, but not all of them do give the pensions. Just as an introduction, we can say that pension is a retirement plan or an arrangement where an individual receives regular payment after retiring from active employment. In most of the country, like in Kenya, are considered to have retired from active employment when you reach the age of 60 years. In some other countries like the United States, the retirement age is considered to be 65 years, but this is not for all the careers. For example, for those in judiciary, especially judges, lecturers, the retirement age can go up to 70 years. So now the pension payments are normally made regularly, and ideally it's on monthly basis. So those people, especially all of us, like the teachers, the doctors, the police, the military, and even those in private sector, they normally go and get something at the end of the month in the form of the pension. So there are two main types of pension arrangement. The first one we normally call it the defined benefit pension plan, and this is where the amount that you receive when you retire is already predetermined. For example, we normally hear maybe the president receive a certain percentage of his salary, the speaker of the National Assembly upon retirement receive a certain package, and all those state officers. So their retirement is already predetermined. So the moment you get on board or you're employed, you know that once you retire from that particular work, you will receive maybe 75% of your salary, which is a very lucrative um, amount to receive. Then we have the defined contribution pension plan, which is very common now to the rest of the citizens. These are not they are the one which are mostly applicable to the common citizen, where both the employer and the employee contribute a certain amount to the pension fund. But in this case, in some cases, you can find that the employer is the one who is contributing. So the employer contribute maybe 5% of your basic salary, yeah, and in some other cases, you as the employee contribute 5%, employer contribute 5%, or even more of the basic salary toward the pension plan. So there are pension schemes or pension companies like Zamala. Zamala is a pension fund, so they normally receive pension contribution from companies, and they invest the the pension fund in various schemes. For example, they can invest in government treasury bills and treasury board. They can invest in fixed deposit. They can invest in real estate, and any other investment that may yield interest, so that your money grows. So if, for example, uh, you have contributed, let's say, 400,000 in 1 year, it can grow up to 450 depending on the performance of the investment where the pension company has invested your money. So now we have actuaries in pension um, accounting. So actuaries, these are people who have specialized in underwriting business. Underwriting is basically assessing how much one person should pay. So now these actuaries, their work is, for example, to estimate the present value of the pension liability. So they look at how much is the liability or the obligation that will pay person X worth today. So if, for example, the contribution plan is for 10 years, how much is 10 years worth today? That is what we call the present value. Then they calculate pension expenses like service cost, interest cost, actual gains and losses. They also advise on funding requirements and contribution levels. They assess and manage risk, e.g., investment, longevity, interest rates, and etc. etc. So longevity is where they assess how long can a particular person live, maybe depending on the health condition or other factors. So actuaries also prepare the valuation report for financial reporting and compliance. They support mergers and acquisition by analyzing pension obligation, and they communicate complex pension issues to management and stakeholders. Now, let us come to the issue which is dear to our heart, that is accounting for pension. Now, pension accounting refers to how companies recognize and report pension obligations and expenses in their financial statement, especially for defined benefit plan. So um, there are two main statements that are considered. One is the income statement and the other one is the balance sheet. So in the income statement, this is where the pension expenses is recorded, and in the balance sheet, this is where we record either the pension liability or the pension asset. So in some cases, you may prepay or you may underpay. So if you underpay, that's an accrual. If you overpay, that is an asset. So, and those are recorded in the balance sheet. We are going to see how this is done practically in a few. An example, a corporation provides a defined contribution plan for its employee during year one. The corporation had a required contribution of Kenya shillings 50,000 under the plan and made a contribution of 50 to the pension trust. During year two, the corporation had a required contribution of 50,000 under the plan and made a contribution of Kenya shillings 55 to the pension trust. During year three, the corporation had a required contribution of 50 under the plan. It made a contribution of 40 to the pension trust. So now, if you want to account for this, just understanding the question, how you can put this one in the income statement and in the balance sheet. Number one, you realize that in year one, the organization was required to contribute 50,000, and they indeed made 50,000. In year two, they were required to contribute 50,000, but they contributed 55, so they contributed more in year two. In year three, they are required to contribute 50, but they contributed 40, so they other contributed. So this is the analysis. Year one, required contribution is 50,000, they made 50, so accounting impact, no asset or liability expenses, So in year one, we have fully paid everything. Year two, we overpaid by 5,000. Year three, we underpaid by 10,000 because we are required to contribute 50 and we contributed 40,000. So if you have to pass entries, year one, you are going to debit pension expenses. Year one, you are going to debit pension expenses because it is fully paid and credit cash. Yeah, that is what you are going to do in year one. In year two, we debit pension expenses 50,000. We debit prepaid expenses 5,000. So this prepaid is the one that we have overpaid. Then the cash, it is 55,000 because that is the amount that we paid. In year three, we will debit the pension expense 50,000. The amount that we paid was 40,000, and then there was a liability that we have not paid of 10,000. Yeah, so that is how we do the accounting for pension. A simple example, another simple example here. I don't know whether you can be able to try this one the way we have done it, but just to guide you a little, let me just guide you a little, see how you can be able to pass just the journals that we have done. ABC Limited provides a defined contribution pension plan for its employee. The company is required to make annual contribution equal to 6% of employee salary to a pension trust. The following information is available for 3 consecutive years. So we have year one, total employee salary is this. So required contribution, we have told it is 6%. So here the required contribution, you need to get, okay. So this is the salary. Remember, for defined contribution, what I told you earlier is that employer contribute and employee contribute. But in this case, we are told that the company is required to make equal contribution. So the company will make a contribution of 6% of this. So what is 6% of this?
60,000.
Yeah, 60,000. So in that case, are we going to have any deficit, or are we going to have any excess? So the required contribution is, the company is required to contribute 60,000, and they did contributed 60,000. All right. So in this case, you're not going to have any liability because we have already made the actual contribution. And this is where we said the double entry that you're going to pass is where we debit the pension expenses and we credit cash or bank. So can someone tell me what will happen in the year 2022? Get the required contribution, 6% of 1.2, and then let me know the double entry that you are going to pass.
Year two, when we calculate, we get 72,000. So meaning we paid with an extra 3K.
We did what?
Of which that is, we paid with an extra 3K, 3,000.
Yes.
That means this is an overpayment. We're going to debit it to credit it as, okay. We're going to record it as an asset or an overpayment.
So what are we going to debit?
We're going to debit
So we debit pension expenses with how much?
3K.
No. We debit pension expense with how much?
As
So
in?
remember, let me just take you a step back. So what I have said is that let us just go back here. So what we have said here is that now the first one, year one. So this is the required contribution. This is the actual contribution. So in this case, for the contribution, this is the money that you have paid to as a company. Remember, you are an accountant of a company X, and you are the one who is deducting the employees, and you are also one who is deducting yourself as employer to pay to a pension company. So this is an expense you are paying. It's a pension expense. All right. So that means, and we said last time that increase in expense we debit. So you debit expense in the P&L, and then money has moved out. So you credit cash. The second one, the required contribution is 50,000. Actual contribution is 55. So remember the matching principle. 50 is for year 2. So that means we debit pension expense with 50,000. We debit balance sheet with prepaid insurance with 5,000, and we credit cash with the whole amount. In year 3, we are required to contribute 40,000, but we contributed only 40 instead of 50. So we had provided, or we did not pay what was required. In this case, you debit pension expense with 40,000, then you're supposed to credit. No, you debit pension expense with 50,000, then you credit um, cash with 40, and you credit pension liability with 10, so that the entry can be complete. Remember, all the required, everything in this column goes the P&L. The required contribution, what you are supposed to pay, goes the P&L. Here, actual contribution goes to cash. It either goes to cash. If it is over, it is cash and prepaid. If it is less here, this is like 40, we'll have a liability. Yeah, and this is now what it is. Pension expense 50, what we actually contributed is 40, and then we have a liability of 10. So going back to our example here, so let us do the one for the last one for 2023, and we see whether we can get it. Get the required pension, then get the actual, get either the under or over accrual.
Can I try?
Yes, try, yes.
So our required is supposed to be 78,000,
Good.
and we've paid 70,000. So we have a deficit, a liability of 8,000.
Yes.
So we debit 78,000 pension expense.
Yes.
We credit the 70,000 as cash, and we credit our pension liability of 8,000.
Correct. And that is the only question that you are going to get in the exam as far as this topic is concerned. So, and the question will be in this fashion: create the required contribution for each year. That one you have done it. For each year, determine whether there is a prepaid asset, liability, or neither, and state the amount. That one we have done. and prepare the journal entry for each year to record pension expense and contribution. So we have done the three. So the exam will come in this fashion. Anyone with a question on that? Either you came in late or there's something that you have missed, so that I can repeat. Anyone? So these are the answers, and I think Mary Nyabura has done very justice to that question. So for 2021, we have 6,000 as a required contribution. For 2022, 72, and 2023, we have 78. And then we have the year 2021, no asset or liability because we have paid the exactly. Then 2022, we have a prepaid because we have paid more with 3,000. And year 2023, we have a liability of 8 because we paid less. And finally, for the journals, the first one, we debit expense with 60,000, credit cash. So no asset, no liability. The amount which was required and the one which was paid was equal. For 2022, pension expense, here we paid more. So the pension, the required one was 72. The prepaid was 3,000. The cash was 75. And finally, the expense, the required was 78. We paid 70, and therefore we have a liability of 80,000. Is it well understood, or there's somewhere that you may need us to do again? So if there's no question, that will come. That will make us to come to an end of that particular segment. I want to thank you for being cooperative and active listening and participating in that segment.